Welcome back to Battlefield Trading. In today's video, we're diving into candlestick analysis combined with trading volume and how we use it alongside price action to improve our trading performance. Learning to read trends through volume is a powerful skill, especially if you're patient and serious about becoming a professional trader. With practice, this method can give you a significant edge in the market. Before we begin, here's something important to keep in mind. The concepts we cover today can be applied across various asset classes, whether it's currencies, stocks, or crypto. Price action tends to behave consistently across markets, so what you learn here can be used in many different trading environments. In this video, we'll focus on 4 key elements related to volume, candlesticks, and trading. 1. What is a candlestick? 2. Understanding trading volume. 3. 6 core principles of volume and candlestick analysis. 4. How to trade using volume and candlestick confirmation. Let's jump into the core of volume analysis and how we combine it with price action to level up your trading strategy, right after this intro.
Warning.
What is a candlestick? A candlestick reflects what buyers and sellers are doing in the market. It shows how they push prices around and in which direction that movement is happening. But looking at candlesticks alone doesn't reveal the true strength behind those moves. That's why combining candlestick analysis with trading volume is so important. Candlesticks tell us who's in control, buyers or sellers, but they don't show how strong that control really is. When we bring volume into the picture, we start to see the real power behind each price move. The opening price shows the initial balance between buyers and sellers at the start of the trading session. It's the first trade of the day, set after traders have had time to react to news or market conditions overnight. The open also reflects the intentions of traders at the start of the day. It gives insight into the fresh market sentiment compared to the previous session. The change from the prior close to the new open tells us how investors are now viewing the market. Also, large financial institutions, when planning to accumulate or distribute big positions, often place their orders right at the open. This is when the market has the highest liquidity, allowing them to trade large volumes without causing major price swings. That's why the opening price is considered one of the most critical moments for executing large trades efficiently and with minimal market impact. High price. This is the highest price the asset traded at during the session. It reflects the maximum strength of the buyers, also known as the bulls. It's the furthest point they were able to push the price up before the sellers or bears stepped in and pushed it back down. The high is often seen as a resistance zone, where sellers show strong defense. There's one exception. When the asset closes at the high, it suggests there wasn't any meaningful resistance from the sellers. The bulls didn't get stopped. They just ran out of time. Low price. This is the lowest price the asset, whether a stock, bond, or commodity, traded at during the session. It shows how far the sellers managed to drive the price down before the buyers stepped in and took back control. The low is usually considered a support zone, where buying pressure is strong enough to stop further declines. The exception here is when the asset closes at the low. That signals little or no support from the buyers. And the bulls were only saved because the session ended. Closing price. This is the final price where buyers and sellers agreed as the session ended. It reflects market sentiment at that moment. The close is a key number because it represents the market's final judgment of the asset for the day and serves as the reference point heading into the next session. It's also the price at which traders hold positions overnight, with no chance to react until the market reopens. For many investors, the closing price is the most important one because it summarizes the day's sentiment and sets the tone moving forward. Price change. The change refers to the difference between today's closing price and yesterday's closing price. When this difference is positive, it means demand is outpacing supply. The buyers are in control. When the difference is negative, it signals that supply exceeds demand and the sellers are dominating the market. This change between closing prices is one of the most widely used indicators in finance. It gives traders and investors a quick read on the short-term trend of an asset. Price range. The range is the difference between the highest price, resistance zone, and the lowest price, support zone, the asset traded at during a session. The size of the range tells us how volatile the asset was that day. It also gives insight into how supply and demand forces influenced price action. A wider range suggests the market is more easily moved, with both buyers and sellers showing enough strength to push prices in either direction. This helps traders assess trend strength and asset liquidity. So, what is trading volume? Trading volume is the total number of shares, contracts, or any other type of security exchanged during a trading session. It applies to stocks, bonds, options, futures, and other types of assets. Volume is a key indicator of market activity. It shows how many trades were made and how much interest investors have in that asset. How to use volume to improve your trading skills. To analyze volume effectively and boost your trading performance, there are 5 key volume concepts you need to understand. 1. High volume on rising prices. When volume is high and the price is moving up, it signals strong buyer activity, with most trades happening at the ask price. This often indicates a continuation of an uptrend or even the start of a new one. It can help you spot turning points or confirm an existing bullish move. Number 2. High volume on falling prices. High volume combined with a drop in price means sellers are in control, with trades mostly executed at the bid price. This can point to a continuing downtrend or the beginning of a correction. 3. Low volume. When volume is below the daily average, it suggests the market is lacking liquidity. There aren't many trades happening. Low volume can signal investor hesitation or indicate that the market is pausing before a bigger move. Number 4. Chaotic volume. This term is often used in short-term trading. It refers to a mismatch between trading volume and price direction. Chaotic volume can be a key sign of an upcoming trend reversal, alerting traders to the possibility of major price swings ahead. 5. Normal volume. When volume is around average and price movement is stable, the market is in a balanced state. This means neither buyers nor sellers are dominating, and there's no clear sign of a new trend forming. Using volume in combination with price action gives you a more complete picture of market sentiment, helping you make better, more informed trading decisions. Volume is a key indicator in technical analysis. It helps traders confirm trends and chart patterns. Most traders focus on the charts, especially price movement. When price rises or falls with high volume, it's seen as a strong signal that the current trend has solid backing from the market. So, if you're tracking a major price move, always check if volume is increasing. That's what adds credibility to the trend. Volume is also used to confirm price action patterns, such as the pin bar, engulfing pattern, double top and double bottom, flag formations, and head and shoulder setups. With these patterns, the key levels often carry critical information for traders, especially for intraday setups. Without supporting volume to confirm the patterns and these important levels, the signals from price action can become weaker and less reliable. Another important point, price often moves before volume does. By closely watching price action, traders can start to predict potential trend reversals. For example, in an uptrend, if volume begins to fall, it could be a sign that buying momentum is fading, and the trend may be nearing its end. Watching the relationship between price and volume is essential for spotting shifts in market direction. 6 principles for analyzing volume and candlesticks in trading. Principle number 1. The length of the candlestick wicks, the upper or lower shadows, is the first thing you should pay attention to. Wick length shows strength, weakness, or indecision in the market. More importantly, it can hint at where smart money is stepping in. Long wicks often highlight price levels where either buyers or sellers started to gain control. Principle number 2. If there are no wicks, meaning the open and close are near the high or low, this signals strong market sentiment in the direction of the close. It usually means smart money is acting aggressively in one direction. Principle number 3. A wide candle body indicates strong conviction, while a narrow body suggests weak sentiment. If the candle body is narrow but volume is high, it may signal that smart money is watching the trend closely, preparing to act, or even taking positions in the opposite direction. Principle number 4. The meaning of a candlestick depends heavily on its position within the trend. A candle that appears at the start, middle, or end of a trend, or around support, resistance, or accumulation zones, will carry different implications. That's why it's crucial to analyze candles in the broader market context. Never rely on a single candlestick alone. Always consider the bigger picture. Principle number 5. Volume confirms price action. First, read what the candle is telling you about price. Then check if the volume supports it. High volume during a price move usually confirms the trend. Low volume may suggest hesitation or even a potential reversal. Principle number 6. If the current time frame doesn't give you a clear picture, switch to a higher time frame for a broader view, or drop to a lower time frame to examine the microstructure of the price movement. Trading with candlesticks and volume can be complex, so take it step by step. Traders need to focus on both price and volume. Price helps identify the direction, while volume shows the level of institutional participation. You can trade on any time frame, but keep in mind that shorter time frames often include more noise. That's why it's a good idea to use charts from 5 minutes and up for more reliable analysis. Let's take a look at a bullish candlestick pattern on a daily chart. This pattern forms when the current candle closes higher than the previous bullish candle. It's considered bullish because it shows that buyers are in control, pushing the price higher than the previous session. However, if the current candle closes lower than the previous one, it's no longer a bullish pattern. Instead, it forms an inside bar pattern. Now in a downtrend, the opposite applies. When the closing price is lower than the previous bearish candle, it signals a bearish pattern, showing sellers are in control. But if the price closes higher than the previous bearish candle, it can't be considered bearish. It becomes another inside bar pattern. With the right understanding of candlestick patterns, you can more accurately predict short-term market direction. Pro tips from professional traders when analyzing candlesticks. Tip number 1. We can't control the market, but every candlestick shows where smart money might be moving. It could reflect an attempt to trap retail traders, or it could signal a genuine, powerful trend. To figure out the true intention behind the move, you need one crucial confirmation: volume. Tip number 2. A candlestick only gives you half the picture. The other half is trading volume. Volume tells you whether the price action shown by the candle has real strength behind it. Example: bullish pattern with 2 consecutive higher closes. Let's add a volume chart to this pattern. In this case, the second candle has a smaller range than the first one, but the second volume bar is higher than the first. That might raise a question. If volume represents buying pressure, why is the price range narrowing? When you see a narrow range candle with high volume, there are usually 2 possible scenarios. 1. It could mean that institutional players are selling into the buying pressure from retail traders. This might signal a potential reversal in the market trend. 2. Or it could mean that large institutions are absorbing the selling pressure from retail traders who are stuck in this price zone. If that's the case, the market is likely to break out and continue the uptrend. Now let's look at the third candle. Scenario 1. Volume increases. The candle is bearish and closes below the body of the second candle. This is a strong signal of institutional selling and can be viewed as a reliable sell signal. Scenario 2. Volume decreases. The candle is bearish but closes at the top or within the body of the second candle. This suggests smart money is testing supply and there aren't many sellers left. If the fourth candle closes above the second candle's high, that becomes a strong buy signal. Here's an example of candlestick and volume analysis. We can see that price was in a strong downtrend, confirmed by a series of large red candles with high volume bars, clear signs of strong selling pressure. Next, we start to see doji candles with small bodies, while volume begins to increase. This raises a key question. In a strong downtrend, where volume typically represents selling strength, why is the price range shrinking? Is smart money absorbing sell orders from retail traders? Or is smart money taking advantage of dip buyers, using retail demand to quietly offload their positions? Then comes a large green candle that forms a bullish engulfing pattern, supported by increased volume. This confirms the scenario that smart money had been absorbing sell pressure from retail traders earlier. Based on this signal, traders with a higher risk appetite might consider entering a long position. More conservative traders could wait for additional confirmation signals to validate a clear trend reversal. What follows is a strong uptrend where bullish candles appear with high volume, while bearish candles show very low volume. This confirms strong buying pressure and shows that selling activity in the market is minimal. We've seen that volume is a critical indicator. It helps you measure the strength of a market trend. When combined with other tools, it supports traders in building smarter entry and exit strategies. The financial markets are complex and unpredictable. But to navigate the chaos, always pay close attention to the two things that never lie: volume and price action. If you found this video helpful, don't forget to subscribe, hit the notification bell, and leave a like to keep learning and growing with us. See you in the next video, where we'll dive deeper into more valuable lessons on your journey to becoming a professional trader.